Okay, here's my unofficial, unprofessional, quick explanation of the all-in-one loan. So basically it is a first position HELOC that is tied to a checking account. It mimics what they do in Australia and Europe, where they basically have one bank that you have everything through. So one checking account, one savings account, and one mortgage all through the same bank. So then whatever you owe on your mortgage is calculated based off of what you have in assets as well. For example, if you take out a loan for $400,000, but you have $200,000 in checking and savings, you're only paying interest on the difference. So the interest on this isn't as important because it's the effective interest versus the interest rate. And the interest rate is based off the one-year treasury, which I'll talk about in a moment. So basically, every single night, the money will recast. So if you get a deposit into your bank account for $10,000, it's like a principal payment goes onto that, but you still have access to that $10,000. I use this over and over and over to purchase investment properties and use as down payment because they are secured funds, so you can use it as down payment. You can pay it off and still have access to it again, like a home equity line of credit. But it will recast every night, so you only pay interest on what you owe at that time. That's how you're able to pay it down so quickly and still use it if you want to, or just pay it down and pay it off. It's really, really cool. I did a hard money loan for like $600,000 for 30 days. I paid $12 in interest because it's the effective interest versus the interest rate. So it's just a different calculation, which I'm about to show you next. Okay, so I can send you the link to this, but let's say that you have an investment property, because I really like it for investment properties because right now the investment property hits are so high. The loan level pricing adjustments is what we call them. They're like 4 points. So even if you buy a place for say 400,000, you're gonna have 16 grand just in points just to get the deal. Where this, you don't have that. The rate is a little bit higher, but not that much higher. It's a big difference. So let's say that you have a loan right now though. Let's say we're doing a refinance. It's going to be similar on purchases too, but I like this because this is what a lot of people have been asking me about. So let's say the house is worth $450,000 and you want a loan for $350,000. Okay. And right now you have a 30-year fixed, and let's say your interest rate is, I don't know, you got it a few years ago, so it's 4%. And let's say you've already had that loan for 5 years, so 16 months, okay? Repeating deposits. So this is all of your deposits that goes into that account. So if you, just your deposits or yours and someone else's, your income, your deposits that you get for rent, whatever the deposits are. I understand that when you receive rent, you have a mortgage that comes out too. I'm not looking for that. I'm looking for just deposits right now. So let's say that that is $10,000 a month. Every month. And the one-time deposit is more so for like a purchase. So we're just gonna skip that. And then let's say taxes and insurance, $600 a month. I think that's a little bit high, but depending where you are, my properties in Texas are like 10 grand a year for taxes. So it's pretty reasonable, but for Colorado, it'd be lower than that. And then let's say at the end of the month, what you have left over. So you paid the mortgage, you pay your insurance, you pay your credit card, you pay whatever. So what do you have left over every single month after everything? Let's say 30%. So you have 3 grand left over every single month after you pay everything, okay? So let's calculate these results and see what it looks like. Hopefully it's a good one. Okay, so this is the current mortgage that you have, 25 years left at, what do we say, 4%. This is your total principal balance. This is how much interest you're going to pay, 300 payments. This is your total, okay? 554, 228. Now with this, with that $3,000 that's left over, remember though, it recasts every single night. So let's say you got paid today, you got $10,000 today, but you didn't have any bills come out. So it looks like you have 10 grand sitting extra in that account. Even though you're going to use some of it, that's okay, because what's going to happen is it's going to still sweep to the account. It's going to recast. Now your payment due is interest only based on what you owe, but you don't really technically have a payment because it's sweeping for you every single night. Unless you stop sweeping and stop making deposits, then they'll say, hey, you've got a payment due, okay? So here is the example comparing the two again. So with the all-in-one account, using it correctly, and with what interest rates are currently on this program, your total principal would be $350 again. Your interest would be the $152. Your total saved is $51,000, and look at how much faster you would pay it off. And then it shows you here under the rates and assumptions, it shows what the loan margin is right now, which is what I showed you on that graph. Now remember that could go down. We're hoping to see that go into the 2s, but let's just leave it there for now. This would be your credit limit here. So again, if you paid it down, let's just say, I don't know, you inherited some money or something, you paid it down, you still always have this credit limit available to draw on to reuse over and over and over, like the example that I gave when I bought investment properties, okay? So here's your index, here's your initial rate, and then they're saying what the floor rate is, so it starts at that, and what it can go to is that. But I showed you guys that 10-year, this is opposite of what we're expecting, and then it's just using the average rate here. So the current rate is a little bit lower than this, but it's showing you the average just because of what rates have done. And you can even see like the historical graph here that'll show you all the stuff. If you're super detailed, this is amazing, and I can walk you through it. I'm a very like, just tell me the basics, get me what I need, and let's move on. So this depends on your personality. Anyway, so that just shows you kind of the options there, and I can send you the link, or you can even just go in and get it. It's all-in-one loan North Point, and then you can play with it here. So even if you were to do a purchase and you're like, should I use this for my purchase, or should I just get a traditional loan? You can go in here and make those adjustments. So you can even do it for a primary residence. So let's say you want to buy a house for $600,000. You would need 20% down. What is that? 420, so 480, 120. 30-year fixed. Today's rate on a conventional loan, I don't know, it's ugly. Let's say 7.75. Okay. Now we're gonna do those $10,000 deposits again. Oop, not 100,000. Wouldn't that be nice? And we'll leave the taxes and insurance the same. And then let's just say you have that 40%, or I think we did 30, didn't we? 30% left over. So let's see what that looks like. So again, here you go. What you're gonna pay total over 30 years. Again, this is if you don't refinance. I mean, if you're closing today at 7.75, you're probably gonna refinance in the next year or two, maybe into the low 6s, high 5s, I think is probably gonna be a reasonable rate, but you wouldn't have to with all-in-one loan, because when rates go down, this loan automatically goes down as well. And so you can see the difference here. You save $512,000, and again, you pay it off in 9.4 years versus 30. But I cannot say this enough. You have to use the account the way it is intended. If you keep all of your checking and savings accounts over here and you just kind of run it randomly and you transfer money randomly, it's not going to work the same. It'll work, but you might pay the house off in 15 years. But to really make it work and to focus on the effective rate and how much rate or how much interest you're actually paying versus looking at the ugly interest rate, the effective rate is what you are actually paying. It's huge. I mean, look at that. Over $500,000. It's insane. And it's just money that you already have cash flowing. This obviously doesn't work if somebody's paycheck to paycheck and they only have, a few bucks left over, which I know is really common, especially right now with how high things are. But this is definitely for someone who has a few grand left over every single month. And here you go, chuck it away. I mean, you're not going to make that much money putting the money into like a savings account in 9 years, saving over 500 grand. Like I don't think there's anything like it. So anyway, this is the all-in-one loan, and I love it. Let me know what questions you have.